Hello world, welcome back to our channel. I'm your host Tommy, and every week we make videos about personal finance, investment strategies, and everything in between. If you'd like to get updates in written form, check out our bi-weekly newsletter where we share our opinions about the current market trends, our portfolio update, as well as investment ideas on our watch list. Links are in the description below. Today we're going to be discussing Tesla. That's right, looking beyond the hype and the memes and the antics of the techno king Elon Musk himself, we will be analysing the business at a fundamental level and share our opinions on the stock. Let's get started, shall we? Alright, we'll be breaking down our fundamental analysis of Tesla into two parts. In part 1, we'll focus on the qualitative features of the business, namely, what are their competitive advantages, how well does their management perform, and what are some key risk factors moving forward. In part 2, we'll focus more on the outlook and financials of the business. We'll share our bullish and bearish thesis, our intrinsic value of the stock based on certain assumptions, and finally conclude on whether we think it's worth buying or not. Let's start off with Tesla's competitive advantages. The first is their strong brand. What does a strong brand do for Tesla? Well, according to a study, as reported by Forbes, a study that focused on the relationship between brand quality and brand image has shown that high-image brands like Tesla can recover from lapses in quality while still maintaining the adoration of its user group. Tesla buyers are brand believers. They believe in the electric model and its sustainability. Tesla believers may see Mr. Musk as one of those once-in-a-lifetime visionary yet quirky founders a la Steve Jobs. Owning a Tesla is a badge of innovation and environmental concern. So in my opinion, this is one of Tesla's biggest strengths. No other company comes close in terms of brand image, at least at that scale. The second competitive advantage that Tesla has is their vertical integration. So vertical integration is controlling different parts of the production chain, from raw materials, supplies, manufacturing, distribution, and sales. Apart from raw materials, Tesla actually controls the majority of this production chain to produce their EVs. What this means is they can have superior unit economics relative to their competitors and therefore have higher profit margins. The third competitive advantage that Tesla has is their interests are aligned with governments. Being the front runner of the whole EV revolution, they are seen as more environmentally friendly compared to their competitors. And how does this benefit their business, right? Tesla receives regulatory credits or carbon credits from governments because they are classified as a so-called zero-emission vehicle. And because Tesla only sells electric cars that come under the zero-emission vehicle category, the company always has excess regulatory credits and can effectively sell them at 100% profit. Talk about free money, right? The fourth competitive advantage that Tesla has is their ability to collect and extract value from data. So they do this in various ways, but I think the one that's most interesting is through their neural networks. Tesla vehicles have a lot of sensors around them and collect data from the real world. Their networks learn from the most complicated and diverse scenarios in the world, iteratively sourced from their fleet of nearly 1 million vehicles in real time. A full build of autopilot neural networks involves 48 networks that take 70,000 GPUs to train. Together they output 1,000 distinct tensors or predictions at each time step. So this means that with all of this data collection, right, Tesla is able to build cars that drive way better than humans. Next, let's talk about Tesla's management. First, I'd like to talk about how they have managed to scale up production in their factories. So as of this year, Tesla has 6 factories located all over the world. The Fremont factory in California and the 5 gigafactories in Nevada, New York, Shanghai, Berlin, and Texas. So just to give you an idea of the scale at which Tesla produces electric vehicles, the Fremont factory alone produced 463,000 vehicles last year. What this means is they've already made significant investment to try to meet the increasing demand in EVs over the coming years. Next, let's talk about Elon Musk and his die-hard supporters, how they are actually intricately linked and you cannot separate management from Elon Musk. So, putting aside his personal behavior, which I'm not here to judge, investors should be wary that what he says can affect the stock price significantly. For example, in 2020, when he tweeted that Tesla stock is too high, the shares fell by 10%. In my opinion, that is a risk. But on the flip side, you can say that oh, what if he tweets that Tesla stock is undervalued? It can then pump, right? Despite what you think about the company, you have to account for whether this suits your investment appetite. Next, let's talk about management's hiccups in terms of safety violations and the treatment of their employees. So the first thing is fines. So Tesla, according to the US Occupational Health and Safety Administration, Tesla has been fined more than many other automakers. Between 2014 and 2018, they had 54 OSHA violations and fines above $200,000. In 2020, when Tesla reopened the company's factory in Fremont, California, employees were given a note that if you feel uncomfortable coming back to work at this time, please do not feel obligated to do so. Despite this, 2 Tesla workers say they received termination notices alleging a failure to return to work after they opted to take unpaid leave to protect themselves and their family members when the factory restarted production the second week of May. And late last year, Tesla was ordered by a federal court in California to pay almost $137 million in damages to a black former employee who said he endured racial abuse while working at a factory in Fremont. So if this continues to be a recurring pattern, I can see how this can damage Tesla's brand. Next, let's talk about some of the key risk factors for Tesla. The first of which is Elon Musk himself. According to Tesla's most recent 10K, they specifically mention under risk factors Elon Musk. Quote, "We are highly dependent on the services of Elon Musk, Techno King of Tesla and our Chief Executive Officer. Although Mr. Musk spends significant time with Tesla and is highly active in our management, he does not devote his full time and attention to Tesla. Mr. Musk currently also serves as Chief Executive Officer and Chief Technical Officer of Space Exploration Technologies Corp. SpaceX, a developer and manufacturer of space launch vehicles, and is involved in other emerging technology ventures." So the fact that their CEO is not able to devote 100% of his time on it is a risk. The next risk factor is competition. While the EV space is growing very fast, we have to acknowledge that Tesla has many competitors both in Europe and in Asia. So just to give you a sense, in China, Tesla owns about 11% of EV sales, and they have many other strong competitors such as BYD, which is backed by Warren Buffett. And since we're talking about the production of EVs, one of the key risks is materials. So the EV battery system comprises of many different materials, but a large proportion of them are actually metals. And this means that Tesla is highly dependent on the mining industry's ability to supply these materials. According to KPMG, the mining industry itself faces several risks. Putting aside COVID, they face commodity price risk, economic downturn and uncertainty, regulatory risk. And I would like to also point out that the mining industry requires a lot of infrastructure, and they have to navigate both geopolitical and social risk to be able to start new mining activities in countries that may not welcome them. So if you think about it, the EV space is seen as this environmentally friendlier solution compared to cars running on petrol or diesel, right? But to manufacture the batteries needed for Tesla's EVs, it relies on the mining industry to be able to supply the materials needed. So their risks are actually intertwined. Alright, so we'll be breaking down the outlook and financials of Tesla in 3 parts. So first, we'll be sharing our bullish and bearish thesis for the company. Next, we'll make certain assumptions about the kind of numbers that they're going to hit by 2030 and try to come up with an intrinsic value estimate. And lastly, we'll conclude with whether we think the stock is worth buying or not. Alright, let's start off with the bullish thesis. Suppose that the supply of materials such as copper, nickel, and lithium can grow in line with the demand for more EVs. Then Tesla essentially doesn't have a bottleneck, because they can ramp up production in their existing gigafactories. The second thing that can go well is if there are other revenue streams such as insurance, Cybertruck, or robo-taxis can help to maintain high margins. So according to Elon Musk, Tesla is expected to produce 20 million EVs by 2030. So I'll use that as my first assumption. And my second assumption is that their operating margin can maintain at their all-time high, which is 15%. So moving on to my bearish thesis for Tesla, I think that due to shortages in certain materials, the cost is going to increase, and that will also increase the cost of production for their EVs. And because there's more competition coming up in Europe and Asia, this will decrease their pricing power despite having a strong brand. So Elon Musk's predictions don't often happen on time. In my bearish case, I'm going to assume that by 2030 they're producing 10 million cars per year instead of 20, and their operating margin is closer to 10%, slightly above the industry average. Now let's take our bullish and bearish thesis, add some expectations in terms of rate of return, and try to come up with a fair value for the stock. Alright, so the first way I'm going to estimate the value of Tesla is through discounted cash flow. As of 2021, their cash from operations was 11.5 billion and their capital expenditure was 6.5 billion. So this gives them a free cash flow of around 5 billion, which we'll use in a moment. Next, we have to set expectations for their growth rate. Let's take the best case scenario where they are able to grow their free cash flow the same rate as their revenue growth. This means we take the growth rate of their revenue, which was 7 billion 5 years ago, and as of 2021, it's 53.8 billion. Alright, so now let's go to our whiteboard and set our assumptions. Alright, for our DCF valuation, let's assume that the current price of Tesla is exactly $1 trillion and that their free cash flow is 5.017 billion. The growth rate, we're going to take the revenue growth as our best case scenario. So 53.82 billion versus 5 years ago gives us a growth rate of over 50%. What this means for their free cash flow in 2030 is that we take the free cash flow currently and multiply it with the growth rate over 8 years, and that gives us a future free cash flow of 131.14 billion. So now recall that the price that we should be willing to pay is the future free cash flow over the expected yield. And for a company like Tesla, I'm going to set the expected rate of return to 15%. So 131.14 over 15% gives us a fair value of 874.26 billion. So what this means is that compared to $1 trillion, Tesla's price is currently 14.38% overvalued. Or in other words, I need the price to correct by at least 12.57% before it's worth buying. And that's with really optimistic assumptions that their growth rate can hit these numbers for the next 8 years. Something that very few companies, if any, at their scale has ever been able to accomplish. So using discounted cash flow, Tesla is way too expensive even if we use the most bullish assumptions. The second way I'm going to value Tesla is through the number of EVs produced. So Elon Musk says that they are going to be producing 20 million EVs by 2030. So I'm just going to say, let's say exactly at 2030 they produce 20 million EVs. And that will be my baseline assumption. I'm also going to look at the shares outstanding. So they have been diluting shareholders in the past, over the past 5 years. And I'm going to discount the expected return based on this dilution rate. Alright, so now let's try to estimate the future value of Tesla based on the number of vehicles they can produce and sell. First assumption is that they can produce 20 million EVs per year. And let's say by 2030 the average sale price of a Tesla increases to 70,000. We also assume that they continue to issue out more shares at the rate that they are. So let's calculate their dilution rate. We take their current number of shares outstanding and divide it by the number of shares 5 years ago. This works out to a dilution rate of around 9%. Now there are two possible scenarios. I think in the best case, the operating margin will stay at their all-time high of 15%, and the market continues to be exuberant about the stock. So they value it at, let's say, 60 times earnings multiple. And let's say in a normal case scenario, the operating margins are closer to the industry average of 10%, and the market values them at 30 times price to earnings. Let's do the best case scenario first. So we take the number of cars sold to calculate the revenue. So 20 million multiplied by 70,000, that gives us sales of 1.4 trillion. Earnings is revenue multiplied by the margins, which is 15%, and that gives us 210 billion in earnings. So what would the price of the stock be in this scenario? It would be 210 multiplied by 60, which would be a $12.6 trillion company. And what this means in terms of rate of return would be 12.6 over their current market cap over 8 years, which gives us a return of 37% or 28% after dilution, which is fantastic. Now, in the normal case scenario, revenue would be the same, but operating margins would be lower, so the earnings would be 1.4 trillion multiplied by 10%, so 140 billion in earnings, and the market would value them at 140 times 30, a $4.2 trillion company. And in terms of returns, that works out to be 19.6% or 10.6% after dilution. So this is only slightly better than the S&P 500, and I think the more likely scenario to play out. We hope you've enjoyed our fundamental analysis of Tesla. At this time, I am personally not invested in the stock, but I'm keeping it on my watch list due to their huge growth potential and unique selling point. If you'd like to hear more from us, subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm, and if you have found this helpful, share this with your friends and family. We'll see you in the next video.